Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, in our 26th year in business. It's Thursday afternoon, March 5th, 2015, and the title of today's audio blog is The Mythical Services Boom. I have lots to cover, and given tomorrow's NFP employment report, in which the government will again try to convince us that hard data be damned, global economic collapse be damned, quote, jobs are being created at a record pace. To that end, yet again I'm having trouble finding a suitable starting point, as global, horrible headlines are emerging so rapidly it's hard to believe the big one hasn't, once and for all, entirely engulfed the planet. Not that I'm looking forward to it, of course, but an historic monetary crisis is mathematically certain and likely much sooner than most can imagine. That said, in scanning through the 6 pages of notes I've created since writing yesterday morning's article, the decided winner of the Scariest Headline Award emanates from none other than Maestro Jr. himself, whom I thought would be smart enough to shut his trap and vanish into obscurity after the horrific global catastrophe he resided over for 8 years. At least Alan Greenspan, i.e. Maestro Sr., has the tact and intelligence of trying to distance himself from the carnage he caused by claiming gold is the only real money, QE isn't working, and economic calamity is headed our way. But no, Ben Bernanke has gone the other direction in advocating a whole new level of economic centralization, otherwise known as communism, fascism, or totalitarianism. Take your pick. When he yesterday claimed the president should have the power to declare, quote, economic emergencies along the same lines as declaring war, which last I looked was theoretically the responsibility of Congress, despite recent usurpation of the Constitution. Specifically, he claimed, the Constitution gives the president significant flexibility to respond to military situations. So it makes sense to give the president some ability to declare emergencies or take extraordinary actions and not put it all on the Fed. I'm not sure what's more terrifying, a puppet like George Bush or Barack Obama being declared commander-in-chief or financial emperor, as frankly it's difficult to discern which role will cause more catastrophic damage. And by the way, note how Bernanke specifically seeks to, quote, not put it all on the Fed, which was probably the only intelligent thought he espoused in trying to run as far away from ground zero as possible. And by the way, if you think what Bernanke proposes isn't coming, I've got a bridge in Brooklyn to sell you. Next up, let's discuss the rapidly spreading wildfire that is the global economic collapse. To wit, let's just go through the past 24 hours, which in any other space and time would have caused an all-out financial panic. Again, in due time. But for now, the world's most powerful weapons of mass financial destruction, in the form of algorithms, derivatives, and relentless central bank market support, both covert and overt, have kept the game alive far past its typical lifespan, in creating historic financial market bubbles, wealth disparity, and simultaneous inflationary and deflationary disasters. Let's start with yesterday's historic American Petroleum Institute inventory build at 10.3 million barrels, representing an all-time high weekly build, well above expectations and adding to an already 80-year high. And this atop Tuesday's 3 million barrel build of international inventories, with everyone from Saudi Arabia to Iran to today ExxonMobil forecasting higher production this year. And this despite the plunging rig counts Pollyannas cite as a reason for expecting near-term reduced supply, which, as I have pounded the table on for months, has not a chance of occurring. To that end, the newly formed Oil PPT, for the 4th straight week, rescued oil prices after their initial post-inventory report plunged below $50 a barrel, in what is becoming as much a market mockery as the equity PPT and gold cartel. Clearly, said PPT is as terrified as even MSM cheerleaders like CNBC, which yesterday wrote of the, quote, crude reality that oil poses the biggest political risk, and thus they are pulling out all stops to prevent the horrifying truism that from fully expressing itself. This is why I wrote in January that oil is, quote, that other Achilles heel of the powers that be, in and of itself capable of destroying them just as much as soaring gold and silver prices, meaning plunging oil prices. Of course, just as is the case with lumber in free fall as we speak, no amount of paper buying will be able to overcome the utterly massive levels of oil inventory seeking a home, to the point that, as we speak, countless dozens of fully packed tankers are seeking ports the world round, in many cases finding it difficult to find unfilled storage capacity. And thus, it's only a matter of time until the same forces of economic Mother Nature screaming for higher gold and silver prices will achieve their goal of much, much lower oil prices. Barring hyperinflation or Middle East war, of course. And then you have the global currency collapse that exploded yesterday and went nuclear this morning. And I do mean nuclear, as it was only yesterday when the euro fell below 1.11 per dollar for the first time in 11 years. And today, just 24 hours later, as I write, it is about to fall below 1.1 euros per dollar. Not to mention, the yen is challenging its multi-year lows. The yuan is at a 2-year low, and the offshore yuan, meaning the unofficial yuan trading, is even lower. And that was following last night's lowest PBOC Chinese growth rate assumption in 11 years. Not to mention, the night before, when the Japanese growth numbers came out, were way, way below expectations, confirming that Abenomics is failing miserably. But around the world, it's where the currency collapse is really, really being seen, and none worse than the Brazilian real, i.e. the so-called BRIC, that is rapidly plunging into the abyss due to its massive reliance on commodity exports and massive debt-burdened infrastructure. The real has plunged to a record low of 3 per dollar this morning, despite an emergency overnight rate rise to a 6-year high of 12.75%. Frankly, the real's 36% plunge since year-end is taking on ruble-like proportions. And the scariest part of all is the Brazilian central bank's claiming their target is only 6.5% inflation, which, by the way, they have not a chance of achieving. As symbolized by Petrobras, the state-owned oil company racked by corruption whose stock price is headed towards zero, the so-called Brazilian miracle is but a cesspool of economic burden on the verge of a dramatic currency collapse. Which is probably why real price gold is now within 1% of its all-time high, just like many other emerging market currencies around the world. And speaking of BRICS, apparently the PBOC has plastered billboards all over China shouting RMB, the new choice, the world currency. Gee, I wonder what that portends, particularly given that the Chinese government by far owns more gold, and likely silver, than any entity on the planet. And back to the front line of currency Armageddon, that is the collapsing euro. From the theater of the absurd, Mario Draghi just gave a speech claiming the ECB has, quote, already seen a significant number of positive effects from its monetary policy, including improved borrowing conditions for firms and households. Does he mean QE, which hasn't even started? It's starting on Monday. Does he really expect us to believe households are borrowing more because interest rates have dropped from 0 to negative 0.2%? And this amidst a horrific recession throughout all of Europe? Or that the historic collapse in the euro and commodity prices has, quote, benefited the European economy? Well, don't worry, as he still assured us this morning that QE to infinity is here to stay, and claiming, incredibly, again, before his trillion euro bond buying frenzy has even started, that he may well extend it beyond the initial September 2016 termination date if the ECB's mythical, manipulatable 2.0% inflation target isn't met. Which is probably why European bond yields are in free fall, with the German 10-year bond yield, I kid you not, front-running such uber-dovish lunacy this morning by plunging from 0.42% to 0.31%, again, this morning alone. And thus, to the 300 million plus Europeans and 250 million plus others whose currencies are pegged to the euro, aside from the handful of money managers benefiting from the ECB's free money, they have watched the euro's international purchasing power decline by 25% in the past year and 7% in the past 2 months alone. And all I can say again is thus, congrats, it's about to get much, much worse. And speaking of pegged currencies, let's not forget our friends at the Swiss National Bank, who not only prove central banks are not omniscient, but betrayed Swiss citizens in a manner far more sinister than even Alexis Tsipras in Greece, by not only preventing a semi-gold standard from returning, but reneging on its suicidal euro peg just 3 weeks later, and instituting negative interest rates. Well, guess what they're up to now? Yep, they appear on the verge of instituting a new improved euro peg closer to 1.05, compared to the old peg of 1.2. which, given the euro's accelerating freefall, I would expect to dramatically worsen as Grexit fears explode in the coming months, taking the new peg, if it's indeed instituted, mere weeks to be broken through as well. And then there's the United States of Recovery, whose reserve currency exploded to a new 12-year high this morning, despite yesterday's horrifying oil inventory data and today's quinella of data misses. Starting with, on the eve of yet another fraudulent NFP employment report, the biggest, most unexpected surge in jobless claims in 10 months, a falling payroll to population report, and the second straight month of 50,000 plus layoffs, according to the Challenger report. Better yet, Challenger's CEO claimed that given the huge amount of retail layoffs, which, by the way, I predicted in my 2015 predictions audio blog, the pattern is clearly one of recession, not expansion. Throw in this morning's plunging productivity, surging labor costs, partly due to mandatory minimum wage increases, of course, and oh yeah, negative factory order growth for the sixth straight month versus expectations of an increase, and it becomes crystal clear that in fact the U.S. economy is free falling as rapidly as the rest of the world. Which is probably why FOMC voting member Charles Evans claimed yesterday that rate hikes should not be considered until 2016, i.e. never, as even the Fed's own projections now call for just 1% GDP growth in the first quarter, even with the myriad adjustments bound to skew it upwards. And this following a fourth quarter rate of just 2.1%, which undoubtedly will be revised lower as well. And don't forget, we're still just a week after Janet Yellen broke every conceivable Humphrey Hawkins testimony etiquette by actually giving incremental monetary policy guidance during such a statement in which I called the most unequivocally dovish FOMC statement in memory. But don't worry, despite all the gloom and doom, as exemplified by Friday's horrifying plunge in the Chicago PMI index from 58 to 45, a level last seen in October 2008, the Island of Lies economic data depicting U.S. services businesses remains strong. Yes, my friends, the entire global economy is free falling, yet WTI oil prices are not allowed to fall below $50 a barrel, and PMI fabricated statistically significant propaganda pieces, such like the ISM service indicator, are not allowed to sync with reality. Right now, such Island of Lies data are standing out like thumbs so sore they need casts on them. This is what I meant by Island of Lies, and if the BLS attempts to post another, quote, better than expected NFP report tomorrow, said island will undoubtedly be even more isolated than ever before. Of course, no matter how, quote, strong said report is, as always, all one needs to do is look at its ugly internals to realize such strength is not only an illusion, but one easily spotted. And one more point before I go, putting an exclamation point on the ongoing, thorough research I've done into the expanding precious metal supply crisis. To that end, I no longer have any doubt that peak gold has arrived, with peak silver right behind it. Yesterday we learned that the world's largest silver-producing nation, Mexico, experienced declining production in 2014, enabling it to join fellow North Americaners, the US and Canada, whose silver production peaked years ago. Moreover, the world's top silver producer, Fresnillo of Mexico, reported further dramatic mine depletion, and for 2015, despite significant capital investments, anticipates silver production to be flat at worst and barely higher at best. Comically, it boasts its plans to add an additional 20 million ounces over the next 4 years, or just 2% of the current global production base, undoubtedly requiring massive capital investments that haven't yet been authorized, market conditions pending. In other words, if this is the best has got, the global silver industry hasn't a prayer of materially growing at all, let alone if said global depression continues to weaken base metal prices, causing reduced silver production in the form of byproduct. And topping it all off, comments from the CEO of Pan American Silver this week, one of the world's top silver producers. In an interview I posted in my PDAC, the Epitome of Mining Ineptitude article yesterday, he flat out said Pan American's all-in cost, not cash cost, its all-in cost of production is $16.50 per ounce, and that Pan American is actually in the lowest quartile of industry cost. In other words, strongly validating what the Miles Franklin Silver All-Star Panel webinar participants concluded this fall, that the industry must have $20+ silver to be profitable, and closer to $30 silver to actually survive over the long term. At this point, he claimed nearly all cost-cutting measures have been exhausted by the industry, such as the exploration expense required to maintain a viable industry, and thus at current prices it won't be long before mass production shut-ins start to be announced. And thus, the other reason to own precious metals, the Miles Franklin blog has discussed ad nauseum, i.e. the mining industry's inability to avoid bankruptcy at current metal prices. And again, I go back to my article a week ago that's called Initial Mining Estimates, Mining Earnings essentially validate or guarantee peak gold, because we saw that the top 7 producers in the world are expecting lower production next year. Well, to that end and countless others, I cannot emphasize enough how imperative it has become to protect your hard-earned savings with real money, i.e. physical gold and silver. As in the long run, real money always protects wealth. And frankly, said long run could turn out to be far less long than most can imagine. And if you decide to take action by buying or storing precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks very much.